Hey everybody, welcome back to the channel. Okay, Roku. What the heck does this company do, and why is it the second largest, biggest holding in Cathie Wood's ARK Innovation ETF? I want to answer this question today because I have been wondering about this question myself. I've been seeing in a lot of comments because I obviously do a lot of Palantir videos, and a lot of people are like, hey, Amit, what do you think about Teladoc? What do you think about Roku? And I'm like, well, Teladoc I kind of understand in terms of it going after the healthcare market and it's telemedicine and everything's going digital, and there's like a real big chance for an opportunity for it to explode. Don't really understand it too much yet. Still have to go deeper. But Roku I never got. You know why? Because I have a Roku downstairs, and it kind of sucks, to be honest. Like, all it does to me is allow me to go on to Netflix or like watch YouTube from it or something. Like, I don't understand what's so special about it other than it says Roku. In fact, I tried to go on the web browser on my Roku TV because I wanted to go to an illegal movie website to go watch some movies. And on my Samsung TV, I could go on their web browser through their interface. Like, you know how you go on like Google Chrome on your computer? Like a smart TV usually has like a web browser where you can click on it and then access the internet. And my Roku TV didn't have that. And I was like, this is stupid. Like every smart TV is supposed to allow you to connect to the internet, not just go through the internet through the selected apps that are given. So I was really annoyed at the Roku TV. And that's why I was also really annoyed, because I like Cathie, I like ARK, I like disruptive innovation. I vibe with the vibes. But I don't know how Roku is disrupting anything. It's disrupting my ability to watch a movie illegally online. And that's when the magic of Twitter started going into this. If you're not following me on Twitter, please follow me there. Amit is investing. There's a lot of fun memes and tweets. So if you like the videos, there's a lot of fun little jokes I put out. We get through the pain of the market every single day together. But I came across a tweet, and let's go into my computer right now. Okay, this is a tweet from a ARK analyst named Nick Grouse. And I came across this tweet. This tweet is from May 8th, 2020. But this, I think it's better sometimes to come across Twitter threads, which are kind of like articles, but they're more easier to consume, versus finding articles, because it kind of just hits you. You're more likely to consume the information. It's short, it's right to the point, and then it gets you the analysis. Now, real quick before we get into this video is not going to go super in-depth into everything about Roku. I have to do a lot more analysis and research and really try to understand all the fundamentals and their numbers. But top level overview, which is what I think everyone's wondering about, which is why does Cathie like this stupid stock? What is so good about Roku TV? Here's what you need to know for why it matters. To summarize both Roku and the Trade Desk's Q1 earning calls, by the way, Trade Desk is a advertising technology platform, linear TV is dead. What is linear TV? Linear TV is the stuff you probably grew up with a channel, and you went to the channel and there were ads in between the shows you were watching on the channel through like Comcast or whatever. That's dead. We couldn't agree more. We think the number of U.S. linear TV households will fall from 86.6 million, which is it is right now, to roughly 44 million by 2025, a 48% decline. So it's okay, before we get into Roku, this is the first level of uniqueness we need to understand. The unique thing that's going on in the status quo, which is another piece of terminology for the present day moment that we have right now, is that in 1970, we had really barely any millions of TVs. And then at 2010, we hit a peak of 110, 112. And then it starts to go down. This is where we have the social media revolution. This is where we have the introduction of YouTube and all these other apps and Netflix and all this stuff, where people start cutting the cord, and they cut the cord so dramatically. Look at this, from 2020, where we're at around this area right now, down to from 2010. I mean, that's a steep decline if you look at the line, the slope of the line, and then it's going to project it to be even lower in 2025. Before we move on into this thread, do you agree with that? Personally, I think it's hard to disagree, right? So the first point of this thesis is do you agree that linear TV is going to die at the level at which it's going to die, in which people are just going to start cutting the cord? Given the dynamics of how entertainment and media is transforming in the new age, I think it's hard to disagree with that in generally. So I kind of agree with that large projection. eMarketer forecasts a 4% decline in linear TV households over the next few years. Trade Desk conducted a survey that found that across all households, 11% of those who still have a cable plan to cut the cord by the end of the year. That number goes to 18% for 18 to 34-year-olds. That makes a lot of sense, because 18 to 34-year-olds do not sit on a couch and go to a channel to watch TV. It just doesn't happen. I mean, some of you may do that, and correct me if I'm wrong, but most people that I know, at least from the 18 to 34 demographic, are hitting Netflix or they're hitting YouTube, right? Or they're hitting some other streaming service if they sit down on a couch and actually plan to watch TV. It's just not happening at the level of cable TV and channels like it was before. The rapid pace of cord cutting will cause a dramatic shift in linear TV ad spend. Here is where the disruptive innovation is happening. The advertising tech money in TV is bonkers. The TV advertising market in 2021 was $65 billion. That means advertisers spend more than $65 billion to get in front of your eyes in the middle of a show that you are watching on regular cable TV. That's going to start transitioning. Steve Louden, Roku CFO, on last night's call, the best analogy for what will happen between linear and OTT ad spend, which is over-the-top media, is what happened to the print business during the Great Recession. That's their argument. So look at the print advertising decline. From 2006, it was about $80 billion of ad revenue going to print print advertising. So like the New York Times, Wall Street Journal, you look in the newspaper and there's a bunch of ads because people are reading the news. Well, people don't read the news that much anymore. People don't really look at the newspapers. I mean, it happens, but not at the level that it was happening, obviously, in 2006. By 2014, that went down to $30 billion. That's a massive decrease in the amount of money that's being spent in print advertising. U.S. linear TV advertising was at around $70 billion in 2016, and it's going down and down and down all the way into 2024. This is what it's projected to be, around 30 to 33 billion. That's going to be pretty big for the companies that innovate in this space. Print has been seeding the audience significantly into digital media because digital publications have been stealing a lot of those advertising, a lot of the advertising that's been going on, 2000 to 2008, but it took the recession to really reset the investment levels in print. It has never recovered. So it was already declining from 2000 to 2008. The recession really hurt it. And obviously the recession 2008, 2009 is when a lot of digital platforms started coming up, which is where the advertising dollars started to go. Now, the primary reason we haven't fully seen the cutting of the cord yet, and this is a really good point, is sports. And this probably I think a lot of people can relate to if they're watching, or if they are watching this video right now that also care about sports. According to Trade Desk, 60% of those with cable keep it primarily for live sports. Now, I used to watch live sports, and now I just get the highlights on YouTube. It's just the way it operates. It's a lot more efficient, a lot more easier for me to get the content. So that I can see why people won't cut their cord. However, if you've noticed, MLB signed with YouTube, NHL has hockey on Fobo TV, Amazon has partnered with the NFL, Hulu has partnered with live sports for the NBA, no cable required. So as you can see, these major streaming platforms that control the majority of how attention is shifting are just going to get the live sports ad spend. That these technology platforms are going to be able to cut deals with major live TV sports because they have all the money and they have all the attention. So they really do have all the leverage here. And if major live TVs can't go get the same level of audience, which means they can't sell the same level of advertising, which is how all these TV sports actually make money, basketball, NFL, NHL, and MLB, then they're going to have to partner with the companies and the tech platforms that actually have the attention. Now, how does Roku make money? Roku generates money in numerous ways. One method is selling its set-top boxes, so like literally the hardware boxes that you buy, which essentially is a gateway into other platforms. So you want to think about the Roku box that you buy or the Roku TV that you buy as an iPhone with apps, meaning the Roku TV OS is an operating system by which all the other platforms are integrated onto its operating system. So Netflix, Disney Plus, etc., they reach audiences because Roku has such a foothold in the market in terms of, they've been around since 2002, and they went public in 2017. So they really spent a long time building out that customer base. And because of that, so many people have Roku TVs, and Netflix, obviously, they want to sell a subscription for their content. So how do they get access to you? They have to be on the Roku TV, because if you load up the Roku TV and Amazon Prime is there and Netflix is not there, Netflix is screwed because people are going to choose Amazon Prime. People are pretty lazy. They choose what's in front of them. So Roku TV is an operating system. The iPhone App Store is an operating system for developers to build content applications on top of that operating system, which is how Roku operates. These devices are available on their website, Amazon or Walmart. Roku offers a lot of devices, streaming sticks, audio bars, HDMI-enabled devices, so their hardware business is doing pretty well. And Roku offers the devices for close cost. Ad-supported Roku has higher margins, and it is possibly made for by this, over 60%. And almost 30% of Roku's income now comes from device sales. The contribution of less than 1% of the profit is the most significant one. Roku also has licensing fees. They have offered other TV makers the ability to integrate its operating system, which is the key value proposition here when it comes to why I think how Cathie's thinking of it, onto their own devices. It is projected that Roku-enabled smart TVs in the United States will claim a market share of 38% in 2020 to take the lead. In addition, the corporation already holds 31% in Canada. Roku makes money whenever someone activates one of these smart TVs. Profits from each gadget are stated in the contract between the companies, which is not public. So they make deals with these companies to create a contract, a licensing fee, that when someone signs up for a service via Roku's operating service, Roku gets a piece of that service. So if you sign up for an $8 subscription to Netflix, I don't know, maybe Roku gets like $1 from that or something. Just like Apple takes 30% of all the App Store fees. So if you sell an app on the App Store for like $10, Apple gets $3 out of that because they take 30% because they gave you the traffic in the first place. Advertising fees. Roku introduced its own branded channel in 2017, which showcases material from third-party media firms. So Roku doesn't really make the content. They just license the content from third-party media firms. And Roku channel offers more than 100,000 movies and TV shows. There are more than 100 channels to explore. And they fund their operations by displaying ads in between programs as well as during their breaks. A share of the advertising revenue is subsequently passed out to their licensed partners. The Roku channel is now one of the most significant revenue-generating channels the firm has. So it's not the hardware that's creating all the money. It's not the operating system. It's the fact that their advertising business is so intense because of this Roku channel, this sort of integrated cross-communication platform that they have within their devices, that they're really able to make a dent in the advertising market. The Roku service is also dedicated to delivering viewers the best commercials so the ad quality is decent and enhancing its advertising partners' earnings. So where is the disruptive innovation actually coming from? The way I'm thinking about it, and again, I'm going to go deeper in future videos, try to understand this a little bit more. I haven't started a position in the stock yet, even though it's decimated because it hit 480 or something at the peak of 2021, which was up 2,000% from 2017, which Cathie looked like an absolute genius during the time, and now it's come back down. But if you think about it, nothing has changed, right? Like when it hit 480 and it was up 2,000%, probably it was a little bit overvalued. Everything was overvalued. But now it's down to under 200. And it's like, well, nothing has changed. Nothing about the macro level dynamics on how people are consuming content as per the linear TV stuff that we talked about has changed. Nothing has changed about live sports going to technology platforms. And nothing has changed about Roku's business in terms of the devices that they're selling or the operating system or any of the true fundamentals. They did have a decrease in growth in 2021 as per 2020. That happened for every company, especially media companies. I mean, even YouTube saw a little bit of decrease of watch time happening on YouTube because people started going out more because they had so much money that was saved up and they wanted to have more experiences after the lockdown stopped. So there was a decline in the level of viewing that happened at around 6%, and there was a decline in the level of accounts that were signing up at around 60%, which is a pretty steep decline. But that's not a reason for the entire thesis for the investment to go away. So to me, the thesis for the investment, the real innovative part here is that if Roku operates as the operating system for hundreds of millions of TVs throughout the entire world, and in the United States it's going down as from 80 million to around 40 million in 2025 in terms of cable. If 40 million more TVs go away, and there's only 40 million traditional TVs left in 2025, where do those 40 million people get their content from? It's going to have to be from some TV provider, right? Like they're not just going to be on their computer or their phone. They're going to most households have some type of TV. If Roku takes up even 50% of that market, I mean, you're talking about 20 million more households that are accessing Roku devices, which means A, they paid for the device, so there was a purchase fee, so there was a hardware fee right there. B, they signed up for other services through Roku's operating system, which means there's a profit sharing agreement or a revenue share agreement between Roku and the apps on its platform, just like we talked about with iPhone and App Store and Apple and app developers, for 20 more million households. And C, there's a ton of content being watched through Roku's channels and TVs and partner third-party channels, in which the $65 billion advertising market is going to start to transition into where the attention is on TV. And if the attention is not on the traditional networks like CBC, NBC, CBS, and ABC, and it's on all these Roku channels or these integrated third-party people that have to go through Roku, where there's a world in which CNN and CBS and ABC, they have to go through Roku because no one's watching it through their traditional cable cords, then that means all that ad money is going to go to Roku, and there's going to be profit-sharing agreements and revenue splits in which Roku gets a bulk of that market opportunity if they're able to capitalize on actually getting those 20, 30 million households by 2025. That to me is the big market opportunity here. Now, am I super bullish on it yet? No. I know I'm a little bit energetic because I'm trying to kind of make the point of why I think Cathie's bullish on it. But that is a pretty unique thesis. And that's a pretty unique thesis if you're betting on an innovative world in which attention is changing. This is Cathie's bet on where attention is going. And if she believes that attention is going in this way, backed up by really numbers and research, and that's the thing I really love about their deep dives on these stocks. There's a lot of numerical analysis and historical trends to sort of project where the future is going. That's where this investment decision ultimately comes from. So let me know your guys' thoughts. I hope that gave a good overview of what's going on. I know it didn't get super, super deep into the numbers, but I wanted to just present a general argument. So at least when you think about this in the future, or someone asks you about it, you're able to say, hey, this is what Roku does. This is the market opportunity. And this is why Cathie and a lot of other people are invested in this stock, potentially being the future of OTT over the top media in the coming years. So thank you guys for watching. Look forward to your comments. I'll see you in the next one.